Just a reminder that this content is for education and entertainment purposes. All content in this presentation is of general comment only, which does not take into account your current personal or financial circumstances and is not advice. Please seek advice from a qualified and trusted financial advisor before acting upon any of the information in this presentation.
Welcome everyone to another one of Cutcher Neale's Insights episodes. My name is Brad Oldham. I'm the Risk Insurance Manager here at Cutcher Neale. Today I'd like to run through a few of the relevant components with regards to income protection and business expense insurance. One of the focuses here at Cutcher Neale certainly is building people's wealth. However, just as importantly, our role is to help protect that, which is arguably where insurance may come into it. So today we'd like to look at the different types of personal risk insurance. I'd like to give you a bit of an overview of income protection in particular. What is it and why is it needed? There are some major changes that are occurring from the 1st of October 2021 this year. I'd like to run through those with you and also let you know what's still available before those changes. There are some key definitions and options that are still available, along with optional benefits. I'll run through some of the specific injury benefits, which is one of the areas of income protection that not everyone's familiar with. There are also, unfortunately at the moment, if you have these policies, you've perhaps seen the premiums have been going up a fair bit. So I'll just give you an idea of what's driving that, and then just touch briefly at the end on business expense insurance and what that's all about for you. So personal risk insurances, the ones that we typically look at with our clients are critical illness insurance. And that one, for instance, is a lump sum benefit that's payable. It's there to cover off, I guess, a rainy day in a way where someone may have one of the 40 plus defined medical events. The most common ones that people think about are cancer, heart attack and stroke. But the idea behind this is to provide an amount of money that allows you not to work if that's the requirement, because arguably someone could go back to work with one of these defined medical events prior to an income protection policy actually kicking in. The second one will be income protection, sometimes known as salary continuance. I'll run through that in a fair bit more detail. Total and permanent disability insurance is another one that we normally look at with our clients. It's quite complementary with regards to income protection because it's a work-based or an employment-based cover that works in with someone's needs if they're on a long-term income protection claim. Life cover or a death benefit, that's a reality for all of us, unfortunately, but we look at normally some of the lump sum requirements in there. It might be reducing mortgages, etc. So that's another one that we normally chunk into our suite of services. There are also some business risk insurances, which we would touch on for some of our clients, certainly not all of them. Business expense cover, and that's designed, it's a little bit like income protection insurance. However, it's specifically to do with some of the fixed costs in the business. And I will show you a little bit of that towards the end of this presentation. Key person insurance is for, as it sounds, key people within a business who may have an impact if they're unable to continue working in the business. So that could be from a revenue perspective, or potentially there is some debt associated with their involvement in the business, which might need protecting as well. And then the last one that we would look at would be where there are many partners or partners within a business. Doesn't have to be many, can be a couple, whereby we want to ensure that if something happened to one of them, either death or total and permanent disability, and sometimes critical illness, that we can allow an amount of money, an appropriate amount of money that's paid. So a quick income protection overview. The minimum age of entry is 18 years. There are a variety of benefit periods. We quite often recommend benefits payable to age 65 because that seems to make sense. Waiting periods, they depend on perhaps how much money someone might have available to sustain themselves whilst the waiting period goes through. Like all things, there'd be a maximum age of entry and a maximum benefit amount. The maximum benefit amounts I'll touch on a bit later, but they have changed in recent times over the last 12 to 18 months in particular. Depending on your income, if you're a particularly high income earner, then that may have an effect on any new policies written. Doesn't affect anything that's already in place. Depends on the cover expiry as to what's appropriate for the client, either age 65 or 70. Ownership's pretty important. The simple premise with income protection and also all insurances is that whoever owns the policy receives the benefit payable. So our role in this is to ensure that if at claim time, then you need to receive some money, then we want to make that as easy as possible. And so quite often personal ownership is the most appropriate way. The premium types, that can vary depending on the circumstances and the cover type. Some of the cover is no longer available. These cover types, agreed endorsed, is no longer available, but there are existing policies with that in play. So income protection, what's it all about? Well, basically it replaces earnings by personal exertion. So at the end of the day, that means it's not going to cover off any of your investment income, but it's to cover off the money that you earn doing your role in a day-to-day basis to earn an income. It's based on your illness or injury whilst you're under medical supervision, and normally pays around about 75% of earnings. And that does vary though, depending on the income that you earn. The way they pay that out, monthly payments are made. They're made in arrears, so we need to consider that when we're looking at how long you can sustain yourself financially. There's an extra month in there that you need to think about. And the other thing with income protection is the benefit that's paid is assessable income, like your current income as well. And I suppose on the other side of that, that the premium that's paid, it's tax deductible at your marginal rate if the if the policy is personally owned. So what's insurable income? If you're an employee, fairly simple. It's your salary package. So it'll be your salary, wages, fees, any fringe benefits, commissions, etc., etc. So that's normally fairly easy to work out. With self-employed people, it's sometimes, well, it's not difficult to work out, but there's a little bit more to it. It's the basic premise is income less expenses plus add backs equals your insurable income. So normally when we're looking at that for our clients and talking to insurance companies about that, they'll want to see financial evidence, and that's often 2 years worth of full financials for self-employed people, whether that's sole traders, partners, or employees of your own company. The things that they don't look at are the 3Ds, the dividends, distributions, and drawings. So they figure that you've already got those, so they're not going to add that back in as well. So why do you need it? I guess there's a view held, certainly at Cutcher Neale, but probably beyond that as well, that your income is your most valuable asset. So without that, realistically, how are you going to pay for everything else? I guess that's the simple premise. The concern would be that the loss of several months' worth of an income could be problematic. You might be able to sustain that and get through. On a broader scale, though, the loss of income on an ongoing basis could have quite a significant financial impact. The loss of earnings on an ongoing basis could have quite a significant financial impact. If you are on an income protection claim, then ideally it's reducing the pressure that you're under whilst you're ill or injured. And then you also potentially have the added benefit whereby a partner may not need to increase their working hours if you're injured or ill and unable to work. So I alluded to some significant changes that are occurring, and these will occur as at 1 October 2021. The main things, which I'll go through in a moment, the claims criteria, any payments that are being made, the disability definitions, and also renewals of those particular policies. So with the claims criteria, I guess the premise that we consider with a claim and any insurance policy is if you're going to bother having this insurance, you want to be in the best possible position at claim time. So this is where we see some concerns coming up with the new policies that are going to be offered. They're going to be considerably watered down. And this is probably an example of that. So at the moment, for instance, we could claim using your best rolling 12 months of income over the preceding 3 years. There's also a 3-tier definition, which is hours, duties, and income, which I'll touch on in a moment. So what's going to change there, and these are the guidelines that have been provided by APRA. They may change, but that's what we understand at the moment. You would need to use the immediate preceding 12 months of earnings prior to disability to justify a claim. And it'll also be restricted to a duties-based definition. So currently available for any benefit payments, normally it's up to about 75% of your income plus superannuation whilst you're on claim. What's likely to happen, the guidelines once again that have been dictated, that they're going to be capped and they're also going to reduce over time. So the general thrust of that is that it's likely to be 75% of your actual earnings for the first 2 years and then potentially 50% thereafter. That may sound a little less than ideal. However, with those in mind, we will have some strategies around to mitigate that. And that might be where I alluded to earlier. There's a relationship between the total and permanent disability and income protection. Well, it might be that we look at higher total and permanent disability amounts to offset the reduction in income protection under these new guidelines. One concern also is the disability definition. So currently, the market-leading definitions that you've signed up for, if you have a current policy, they are in play for the life of that policy. They can't be changed. So the contracts that anyone is under at the moment, everything is okay. They can't change it. The concern with the future guidelines is they're going to provide definitions that are going to be more difficult to satisfy. And we've also been told that that's going to vary depending on the life time that you're on claim for. So, for instance, after, say, 2 years of being on claim, the definition may change from something that's easy to satisfy to something that is less easy to satisfy. Policy renewals, this is another one at the moment. Basically, once you've actually put a policy in place, and again, I guess just reiterating, this is in play until 1 October this year, 2021. So the contract conditions are what they call guaranteed renewable. So in effect, once it's in there, it's done. And each time you pay your premium every year, that renews the policy and you don't need to worry about any changes. What's being touted to change by APRA, and this is the only one guideline that will come into effect in 2022 by October, because the insurance companies were concerned about being able to implement it in time. So APRA have given them some leeway, but effectively there'll be a 5-year policy renewal. So the challenge there will be that every 5 years, the client and or the insurance company is going to renew the policy, and it'll depend on the current occupation of the life insured at the time, and also the financials will need to be provided at the time. The upside is it won't rely on any changes in your health at the time, which is probably fair because that's really what insurance is all about. But the concern might be that any changes they make to the particular policies, well, that's what you'll take on at the time that the policy changes over. So what's still available before all of these changes come into play? There's certainly some superior pre-disability earnings. I'll show you some of the key definitions and options, talk a little bit about specific injury benefits and also some optional benefits. But at the end of the day, most of these 4 points here are going to be taken away from the policies that will be available. So what I mentioned a little bit earlier was at the moment, the best 12 months of the last 3 years is what a client could use as a part of a claims process. Now, that's for a policy that could be written right now. There were policies available prior to 30 March 2020, which had an even more valuable definition, and that was the agreed value component. So those are no longer available in the marketplace. They do exist, and if you have one of those, it's retained. The indemnity is what's available in the market at the moment, and the best of those is the last 3 years. Some of the insurance companies have the best of the last 2 years, which is probably not the direction we would take at the moment. We believe that gives our clients a little bit less flexibility. If you have a policy that's owned inside of a superannuation fund, then they will take the best, your income over the last 12 months, which is going to be consistent with what the new policies will have in play. So what's currently available is 3-tier definition, which is pretty important. It's got the preferred, what they call own occupation definition, which means that if you're unable to undertake one or more of the important income producing duties of your current role, then all things being equal, that's cause for payment to be made. But the 3-tier definition provides more flexibility around how many hours that you might work in a week, the reduction of your income, or those important income producing duties. What is likely to change is that will come back just to the duties-based definition. Benefit indexation and claim escalation, which are pretty important. The indexation component means that each year, once your policy renews, with income protection, typically they increase around about 3%. This does vary from insurer to insurer, but normally your benefit payable will increase by about 3%. And the idea is that that's to keep pace with increasing costs. The claim escalation component is a bit similar. However, it applies to the amount of money that you would receive each year, or would increase each year whilst you're on claim. So again, a similar increase. So those two components right now are available, and they're unlikely to be available in the new suite of insurance policies offered. The other one is the specific injury benefit, and it's interesting because this is one that's claimed on a reasonable amount, and it won't be available in the new policies. And I will show you a little bit about that in a moment. But basically, it provides a multiple of your current income protection monthly benefit payable, depending on the type of injury or event that it is, as to what that multiple might be. But effectively, you could get paid something for say breaking an arm and not actually have to be off work at all. And that's under income protection. So this is what it looks like here a little bit. And they're benefits that are payable from the first day. You might, for instance, have a broken arm. You can see down there in F, whereby arguably you could get paid 2 months worth of your income protection benefit. And I guess the practicality of that might be you might need a day off to go to hospital and get your arm set, but arguably you could go back to work and you would still receive this particular benefit. So we've certainly seen a number of claims on this particular benefit, along with a range of others, but this is certainly one that a lot of people do get injuries, and this is one of the ones that we claim on a bit. Some of the optional benefits that exist in the income protection policies include a critical illness option. So I mentioned earlier that critical illness or trauma insurance can be held as a standalone policy type. With the income protection policies, they also have an option whereby you could tick a box and receive up to 6 times of the monthly benefit for one of those defined medical events. They're typically not the premium offerings when they use this in the income protection component, but nonetheless, it might be something that people consider. For people in the medico space, there's also what they call a needle stick benefit, whereby they may occupationally acquire HIV, Hep B or C, and therefore there's a payment that could be made there. And then the other main component is guaranteed future insurability. This exists in most policies. Some of them have as an additional option as well. So basically allows for an increase without any medical underwriting based on various life events. And that might be mortgage, having a child, getting married, divorced, and a range of other bits and pieces. So these are, again, currently available, but won't be in the future. Everyone hates paying insurance premiums. I'm no different. However, interestingly enough, if it comes time to claim, then everyone's pretty happy that they did pay them. Unfortunately, in the insurance industry, income protection in particular, people who have these policies would have noticed that there have been some pretty significant increases in recent years. And in fact, that's a part of what's driven APRA to wave their big stick over the industry and make sure that they create some more sustainable products. Ultimately, the claims have increased significantly in recent years, and in particular a surge in mental health claims. And I have another slide which will probably show you a little bit more about that. The marketplace at the moment for the premiums that you have paid as far as the returns on investment are concerned has been particularly low for a number of years. So the impact of increased claims and lower financial returns equals less money in the pot. Unfortunately, that's a reality, and the main way that the insurers have been able to sustain themselves is unfortunately increasing the premiums. And one of the other components, there are a couple of different types of premium structures, which I'll show you in a moment, but stepped premium structures, by nature, they increase each year with age. So some of the older policies have increased significantly, and people are seeing that that's becoming potentially unsustainable as far as the cost to them is concerned. This is a bit of an example of stepped versus level premiums. And that's not to say that stepped premiums are not to be considered. It's always on a case-by-case basis, but this is a bit of an example of how that might look in a graph, and it's a little bit scary. However, there are ways to manage that, in particular with some of the lump sum benefits, where we can reduce the benefit amount over time and therefore reduce the premium that's paid by the client. Here are some income protection claim statistics that I mentioned earlier. And as you can see, mental health is certainly the leader of the pack, unfortunately. Then below that, I guess some of the ones that you might expect, accidents and injuries and cancers and the like. Just touching briefly on the last component, which is business expense insurance. As I mentioned at the start, business expense insurance really is, it's sort of aligned with income protection. And I guess my view on that is the alignment is in only that the same reason you would claim on income protection is likely to be the reason you would claim on business expense insurance. So it's that particular health event which is precluding you from being able to go to work and earn the money. So with business expense, it sits around the fixed business costs. Normally, the benefit period is a lot shorter. Not normally, it always is. It's 1 year benefit period, as opposed to income protection, as I mentioned earlier, often through to age 65. So what we look at are some of those fixed costs in the business. And if the client happens to be unable to work, then they have income protection to look after their personal needs, and the business expense insurance is there to look after those expenses within the business. So you don't have to dip into your personal savings or income protection claim proceeds to be able to satisfy those costs in your business that are ongoing. And that'll include a range of things, including some of your employees' salaries and rent and various other components. So the last thing I'd like to reiterate is income protection is changing, and it's going to change forever on the 1st of October 2021. There certainly are some opportunities still to look at implementing income protection policies under the current structures. It's not something that just takes 5 minutes. It's an advice process. Myself or any of my colleagues would go through a whole process with our client to determine the appropriate amounts and how that might work in with the other insurance policies that I highlighted earlier. So if you are looking to take on some income protection insurance for all of the reasons that I might have alluded to earlier, I can honestly tell you now is the time to do it. If we leave this until September, for example, not only will be problematic for advisors to get the advice done in time, but it will also be difficult for the insurance companies to implement the policies in an appropriate time. So my recommendation and suggestion is, if you're going to do this, now really is the time. I certainly hope that some of that was educational. If you would like to know anything further, please contact either myself or one of our risk insurance team at Cutcher Neale. More than happy to have a chat to you about your needs. Thank you very much.
Just a reminder that this content is for education and entertainment purposes. All content in this presentation is of general comment only, which does not take into account your current personal or financial circumstances and is not advice. Please seek advice from a qualified and trusted financial advisor before acting upon any of the information in this presentation.